I talk to a lot of people that are interested in reverse mortgages. Some of them are just curious, some are wanting to have the credit line available, and some are in really dire straits and need the help. Regardless of which group they fall into, about 1 in 3 people I talk to about the home equity conversion mortgage say they don't like the fact that they're adjustable rate loans. Now, I tell them all that there are in fact fixed rate HECM options, but nobody opts for them. And while I understand the negative sentiment around the adjustable rate aspect of HECMs, especially after 2008, my professional opinion is that almost all of these people are overly cautious about the adjustable rate element of the HECM because they don't understand the mechanics of how they work. Now, that might sound a little critical, but here's a test for you to see if you fall into this group. Do you know how the adjustments to the rate of a HECM are determined? Do you know whether there is a cap on the HECM rate adjustment, and if so, how that cap is determined? Do you know how the interest rate impacts the line of credit on a HECM? If you answered no to any of those questions, I'm going to challenge you to watch this whole video. I'm betting that by the end, the adjustable rate aspect of the HECM loan won't be nearly as concerning for you. But before we dive into the details on this, please do me a favor by liking this video and subscribing to my channel if you haven't done so already. I'm really trying to grow so I can reach as many people as possible. My business is built on trying to be as anti-salesy as possible and to be a source of truth in a confusing and sometimes shady industry, so I don't do the cold calling or lead buying that a lot of my competitors do. This channel is one of my main ways of growing my business, so I really appreciate all of you guys spending the time to watch these videos and to help me reach more people like you. Now, let's get into it. What determines your reverse mortgage interest rate? For most home equity conversion mortgages, interest rates are determined by the SOFR index, or the Secured Overnight Financing Rate. The SOFR index is very closely tied to the Fed's federal funds target rate, which is the rate that the Fed controls when you see them adjusting their rates. In plain English, the SOFR is the cost for large financial institutions to borrow money overnight for loans that are backed by US Treasuries. It's an ultra low risk index based on trillions of dollars in daily transactions. All that to say, it's a key part of the overall US economy and even the global economy as well. How does this tie into your HECM loan? Well, the rate on your HECM is usually the SOFR rate plus your lender's margin. The most common margins for the HECMs are 2% to 2.5%. So for example, if the SOFR rate is currently 3.59% and your lender's margin is 2.5%, the rate on your HECM at that time would be 6.09%. With the adjustable rate on the HECMs, the margin usually will not change. Whatever margin you have at closing will typically be the margin the loan has forever, but definitely ask your loan originator about this. The adjustable part of the rate comes from that underlying SOFR index. So as the index changes, your note rate will adjust with it. The SOFR rate does change every day, but your HECM will likely have scheduled adjustment dates each month, say the 15th of each month, for example. So each month, your loan will look at the SOFR rate on the 15th, then add the margin to that rate, and that total amount will be your interest rate for the next month until the process repeats again. So that's how it works. The real question should be, how does the SOFR perform historically? Well, the SOFR has only been around since 2018, so it doesn't have decades of history behind it. What we've seen so far is that it closely follows the broader interest rate environment. When the Fed raises rates to fight inflation, for example, the SOFR climbs with it. As rates have come down, SOFR has also come down along with them. Now, prior to 2018, HECM rates were tied to the 1-month LIBOR, the London Interbank Offered Rate, for more than 30 years. During that time, it behaved very similar to how we've seen the SOFR index perform in the past decade. LIBOR was replaced because it was vulnerable to market manipulation and was part of a scandal in 2010. Basically, the rate was determined based on what banks said they could lend their money for, but SOFR is safer than that because it's tied to what banks actually pay and earn on their short-term lending, not what they're telling people they could earn. So SOFR is based on the actual data instead of estimates from it. Now, because I know some of you will be asking this, what are the highest SOFR and LIBOR rates ever recorded? Well, for SOFR, the highest it's ever been has been about 5.4% in 2024. And for LIBOR, the highest it's ever gotten was 6.82% in 2000. And also important are the average rates, not just the maximum. So for SOFR, the average rate since its creation in 2018 is roughly about 2.5% to 3%. Now for the 1 month USD LIBOR, the average is tough because it's been around for much longer, so you can average it over that entire period or in smaller segments. So in the 90s and 2000s, the average was about 5 or 6%. From 2009 to 2015, it was basically zero, and then about 2.5% until it was phased out in 2018. So what you'll see if you look back over time is that the index plus the margin, regardless of the index being used, equates to HECM rates being pretty comparable to traditional forward mortgage rates. And unless you're one of the lucky people stuck with a 2% mortgage you got during COVID, an adjustable rate can actually have some potential benefit for you. Since it adjusts monthly, when the market is good, you'll get the benefit of that. Your rate will go down with the market. And when it's not good, it will ride that wave as well. But since this is a reverse mortgage, you're not having to come out of pocket to pay that interest, so it doesn't hit the same way it would on a forward mortgage. Now, the next main question I like to ask people is whether they know about the interest rate cap. Most adjustable rate mortgages, forward or reverse, will have some form of rate cap on them. That means that even if the market implodes and the SOFR rate skyrockets, your loan has a maximum interest rate to protect you. Now, frankly, I think the cap is too high. HUD's guidelines for monthly adjustable HECM loans set the cap at 10%. So if your initial note rate was 5.5%, the absolute maximum interest you could ever have on that loan would be 15.5%. Now, the reality is, if the economy ever got to that point that your 10% cap actually kicks in and is enforced, we'd be in major trouble as a society, and you'd probably have bigger concerns than the balance on your reverse mortgage growing. Why do I say that? Well, it's because the balance on your HECM reverse loan doesn't actually matter, technically, at least when it comes to whether you keep the home or not. Now, it does matter, but there's no limit on how large the loan balance gets. And if the balance gets so big that you actually owe more on the loan than the home is worth, for you and your heirs, you're not responsible to cover that difference. That's because these are non-recourse loans. The most the bank can do is ask you for 100% of the sales price of the home when you sell it, less any cost of selling. So really, the interest rate on the loan balance itself only matters if it's essential that you leave the home or some of the equity in the home behind to your heirs, or if you plan on selling the home while you're still alive. If that's not the case, the loan balance doesn't really matter that much. Now, there's another place where the interest rate on your HECM really does matter a lot, and it's not your loan balance. Now, many of you may know this, but modern HECMs almost always come with a line of credit attached to them. So here's a rough example. Based on your age and the property, let's say that you're able to borrow up to $200,000 on your HECM. Now, you only need $80,000 to pay off the existing mortgage. And then let's say you take out an additional $5,000 at closing so you can go on a cruise. Now, in this case, your initial loan balance will be $85,000 plus any fees that were financed in to originate the loan. The monthly adjustable rate on your note, your loan, will be applied to that balance, and the interest amount will be accrued every month. So the loan balance will grow, but the remaining $100,000 to $115,000 that you didn't borrow is available to you as a line of credit. You can borrow from it at any time. And the adjustable rate on your HECM, the rate that's determining how fast the loan balance grows, is also the rate that determines how much your line of credit grows. That's right, your line of credit will grow at the same rate that your loan balance grows. Now, this only applies to the unborrowed amount on the line of credit, but there's not a cap on it, and it can't be locked or frozen. So if the economy takes a downturn, you're still going to be able to borrow against it. Now, if you were to get a HELOC instead of a HECM, the lender could usually restrict your ability to borrow money from that credit line if the market got bad, but not with a home equity conversion mortgage. Let's say that the SOFR were to go up to 20%. They wouldn't restrict your ability to borrow. You'd continue to have access to your line of credit, and your lifetime cap would go into effect as well. So the adjustable rates on the HECM reverse mortgages are super unique in that they're bittersweet. The lower the rate, the less the loan balance will grow over time, but the higher the rate, the more the line of credit will grow, the more money you'll have access to borrow against. So there's really nothing else like them on the market that behaves that way. So that's my argument. The reasons I think the adjustable rate element of modern HECMs isn't really as scary as it sounds. The rate is tied to solid backbone elements within the wider economy, not the whims of your lender. There are protections in place to cap the rate growth in worst case scenarios, and you don't have to pay the interest out of pocket. It comes from the sale of the home, and you can't owe more than the home's value. The rate also impacts how much your line of credit grows. So even in a high rate environment, there's material benefit to you that you get to capitalize on. So I hope you guys found this helpful. And if you are someone who's been nervous about the adjustable rate element of the HECM, I hope that this kind of gives you some liberty and license to rethink that. Now, please don't forget to share, like, and subscribe for more, and use the link in the description below to book a call with me if you want to talk about your specific situation. And until next time, take care.